Welcome to today's webcast, which is the latest in our ongoing series for our clients in APAC. My name is Oliver Stevenson. I'm going to be moderating today's session. I'm the commercial lead for our energy products across the APAC region. As you can see from the first slide, today's webcast is called How Do Ship Owners Ride on the LNG Wave? Joining me today will be two of my colleagues, Rebecca Keller from the IHS Energy team, and also Gary Lee, who's a member of our IHS Maritime team. This is what we're going to be looking at today. We're going to have an overview of the LNG market in Asia. Then we're going to take a look at the current order book and traffic for LNG shipping. And then the third section, we'll look at LNG shipping routes before we move over to the question and answer session. So let me hand over to Rebecca now, who will start with an overview on the LNG market in Asia. Over to you, Rebecca.
Hi, Oliver. Thanks a lot for that introduction. Today I'm going to discuss recent trends in the LNG shipping market and identify the key factors driving these trends. Two critical factors we'll examine are the outlook for LNG demand and the impact of new LNG projects and trade routes on the LNG shipping market. So firstly, I'd like to discuss how shifts in inter-basin LNG trade over the past several years has led to spikes in freight rates and a boom in LNG vessel orders. So this chart shows the growth of inter-basin LNG trade flows from the Atlantic Basin and the Middle East to Asia. From 2009 to 2011, the jump in Middle East to Asia trade flows was largely due to new capacity coming online in the Middle East, primarily from Qatar. These volumes are ending up in Asia. From 2011 forward, more inter-basin flows to Asia has been driven by a jump in Japanese LNG demand after Fukushima, and also some new contracts starting up with other Asian LNG markets. This growth in trade flows to Asia has been supported by a weakness in Europe and U.S. LNG demand, as cargoes continue to be diverted away from Europe towards Asia. European LNG imports have plummeted to 35 million tons in 2013 compared to a peak of about 66 million tons in 2011. In 2013, Europe re-exported over 10% of its cargoes, and these reloads were ultimately delivered to markets in Asia and South America. And so far in 2013, we've continued to see a steady flow of re-exports from Europe. The U.S. re-export activity has died down since 2011, along with total imports, which are now just a few million tons in the U.S. And going forward, we'll see more inter-basin trade flows once the U.S. Gulf of Mexico LNG projects begin delivering volumes to Asia within the next 2 to 3 years starting up. And this rebalancing of the LNG market has also been supported by the strong LNG pricing differentials between Japan and other Asian markets compared to Europe and the U.S. Since early 2011, average Japanese LNG prices have ranged from $14 to $18 per MMBTU on a monthly basis. By comparison, in Europe, NBP and the German gas price has been trading much lower at between $9 and $11. And if we look at the U.S., Henry Hub has remained low until the past cold winter brought up prices somewhat. Recent prices we've seen around May, Japan has been about $16, NBP has fallen below $8, while Henry Hub has been about $4.50. And for the next 3 to 4 years, we expect Henry Hub to trade mostly between $4 to $5. You could see some spikes due to seasonality and weather, and the average Japanese price we expect to remain above $14. This slide looks at how the average LNG shipping distance has changed. The shift towards longer trade routes tied up LNG shipping capacity as players sought to pick up spare tankers to access the higher value Asian markets. More inter-basin LNG trade has meant longer shipping voyages. A typical intra-basin Atlantic voyage, so for example from Nigeria to Spain, will take only about 20 days. By comparison, it'll take about 60 days for an Atlantic to Asia voyage. In other words, a vessel can make 3 voyages from Nigeria to Spain the time it takes to make 1 voyage to Tokyo. We think we're really seeing a peak in average shipping distance around this time, and when we look at the impact of new Asia-Pacific supply on average shipping distance, we think it's going to lower it over time. Primarily, Papua New Guinea and Australia are targeting the Asian markets, and that's the next wave of supply that's coming online in the next few years. For example, the distance to deliver LNG from Australia to Northeast Asia is about 4,000 nautical miles or less. When we look a little bit further out, once the U.S. Gulf of Mexico projects start delivering, the shipping distance from the U.S. to Asia can be between 9,000 and 10,000 nautical miles for markets in Northeast Asia and India. So that'll put some more upward pressure on the average shipping distance. And the impact of these trends on the shipping market has been noticeable. Higher LNG demand post-Fukushima in Japan, longer shipping voyages, and the rise of inter-basin LNG trade flows led spot freight rates to hit between 120 and 140,000 in 2012. When ship owners began to see these higher returns, the LNG order book started to pick up, especially for speculative orders, or those not tied to long-term charter rates or LNG projects. And here you can see the conventional new build orders on the bottom. So right after those peak rates we saw after Fukushima, a lot of more activity on the new orders. Since the spike in 2012, charter rates have come down considerably. We can see there the spot charter rate dipping even below $60,000. New builds we see a little under $60,000 currently, and older vessels are even lower, about $50,000. So in terms of when these new orders are going to be delivered, we're seeing a large number of vessels starting to be delivered this year. Between 2014 and 2017, about 112 new vessels will be delivered, and the current fleet is about 377 vessels. So this is a significant expansion, and in terms of shipping capacity, this is about a 33% growth in shipping capacity in 3 years. And we'll see 30 vessels ordered on speculation to be delivered by 2017. So these vessels are what we call available vessels, and they're not tied to a charter. So they're available. And this will continue to suppress freight rates. We will see more cargo reloads out of Europe can help maintain some rates, especially as some of these are delivered to Asia. Some owners, which have received new builds from South Korea shipyards, appear to have delayed release for a few weeks, and in some cases multiple months, due to the weak shipping market currently. In one instance, Golar LNG elected to lay up multiple recently delivered and unchartered new builds to reduce exposure to the weak market. So we are seeing ship owners being impacted by this already. So due to this current strong LNG vessel order book, we expect that the LNG shipping market will be very well supplied out to 2017 at least. And by 2016, about 100 vessels which are on order are due to be delivered, compared to expected demand for new builds of just 80 vessels. Now, some of these new builds are tied to LNG projects. We're seeing the Australian projects like Gorgon, Australia Pacific, Papua New Guinea, Sabine Pass. All these projects have already chartered for vessels. But still, a large number are not tied to LNG projects. We look at the companies that have the available but uncommitted vessels. A lot of them are from Golar, but some are also from GasLog and Dynagas. By 2018, we expect the shipping market to become a little more balanced, and there will be a greater need for more LNG vessels based on our outlook for new projects and vessel retirements. Given the typical vessel construction timeline of 2 years, we expect a number of new build ships being ordered starting in late 2015 or 2016. And part of this demand for new builds will be driven by retirement of older tankers. Currently, there's about 40 tankers that are in use that are about 30 years or older, and the average vessel life tends to be under 30 years. And these older tankers tend to only take the shorter shipping routes. So as more supply hits the market, we may see some of these being retired. In the longer term, the LNG shipping market will be shaped by new LNG projects and their target markets. So here we've shown you LNG demand outlook by region placed with LNG capacity. And we can see the current tightness in LNG capacity and LNG supply has not allowed demand to grow. But we think there's a key number of regions which will ease supply tightness in the market over the next few years. And after 2018, we may even start to see a relative oversupply of LNG. So if we look at Australia, the current construction boom there will add about 61 million tons of capacity by 2018. The growth of unconventional gas in North America will support, we expect, 5 new projects by 2020, about 55 million tons of capacity. And we expect several projects to be developed in Western Canada shortly after that. In Russia, Yamal LNG is expected to start delivering volumes by 2019, followed by growth from Sakhalin and Vladivostok. Despite having substantial new gas finds, we consider LNG developments in East Africa more of a long-term prospect compared to the other new regions for supply. On the demand side, we expect to see a very slow recovery of European LNG demand. We think it could take at least a decade to recover back to peak LNG import levels in 2011. And this is really driven by weak gas demand overall in Europe, and also Europe's status as the balancing market for LNG volumes. So as more supply is available, we can see Europe take in more volumes versus the current squeeze they're experiencing now. When we look at LNG growth, really it's driven by Asia. We think Japan and Korea will provide fairly steady demand. In Japan, they've had a much slower outlook for nuclear restarts than maybe was initially expected. So we'll continue to see Japan pulling more cargoes in. But really China and to some extent India make up the bulk of demand growth. And there's also demand within Southeast Asia from the smaller markets, the new importing markets. And we're also seeing higher demand for floating storage regasification units, or FSRUs, from a growing number of existing and new LNG markets. So similar to conventional LNG vessels, there is an oversupply of FSRUs, as several existing and under construction vessels are not currently tied to a regasification project. Still, there's a growing number of markets which have proposed new floating storage regas terminals, and you can see there are outlook for proposed terminals out to 2016 and then out to 2020 in the next tranche. And markets are turning to FSRUs for a number of reasons. They're very flexible, and they can be developed very quickly as a midterm solution to meet energy needs. As they're floating project, they have a smaller footprint and often require lower investment needs compared to a traditional onshore regasification facility. We have seen several projects in the U.S. being decommissioned due to low utilization and due to low LNG demand. But just as ship owners have been building conventional vessels on speculation, we're also seeing a number built FSRUs on speculation. There's 2 primary types of FSRUs. There's the ones that have been converted from an LNG vessel to an FSRU, and these are permanently moored for regasification. And most of these were done by Golar, and we see these vessels used in Dubai, Brazil, Italy, and Indonesia. And then there's also the new build FSRUs, which have a dual functionality for LNG shipping. So this gives the vessels more flexibility if it's not tied to a specific regasification project, or it can also be used to import seasonal cargoes. Some markets will only require LNG imports for part of the year. For example, in Kuwait, we think that the FSRU there may be used to deliver spot market cargoes this upcoming winter, as there's no demand for LNG in the winter in Kuwait. But still, this is less common, and we do see most of them being moored. As another example, CNOOC's Tianjin FSRU, which was just delivered, CNOOC has seen very high spot prices and regulated prices downstream. So in order not to take losses on LNG imports, they've instead proposed to use this for LNG shipping instead of a regasification facility at the moment. And with that, I will turn it over to Gary, who will provide more details about the shipping fleet.
Thanks very much, Rebecca. Hello, everyone. My name is Gary Lee, and I'm a senior analyst with IHS Maritime. I will now look at some of the existing trends in LNG shipping, including ship orders, operators, traffic patterns, as well as touching upon future routes for LNG trading. So as Rebecca mentioned earlier, current LNG ship orders look to be strong. On the chart on the left, you can see the number of orders broken down by year, with blue being already delivered and in service, and orange for those that are still under construction. Despite the large drop in orders in 2008 and 2009, the industry has recovered strongly, especially in 2011, no doubt aided by Fukushima. In 2013, we saw no less than 43 ships ordered. However, this year, the first half of 2014, we've only seen 12, which is probably a hint of a slowdown of the LNG tanker boom. This is most likely due to the large numbers of speculative ordering, as mentioned by Rebecca earlier. Currently, we have 116 ships on the order book. The top 10 operators by numbers ordered account for 73 of them. Of these, most are speculative orders made by companies such as Moran Gas and Golar, which will drastically enlarge their fleets. This points towards a shift from traditional project-type ships, such as those owned by Qatar Gas, for example, to a sizable chunk of the future fleet being utilized for more spot-based charters. If we compare the growth of current order capacity with growth in global liquefaction capacity in the next slide, we will actually see a pretty good match. There will be some looseness projected in the market in the short term, which will in turn drive down utilization as well as freight rates. Now we'll take a look at how the LNG tanker building market is looking. As we can clearly see, South Korea still continues to dominate the market, especially in 2011, when it led a recovery of the LNG tanker building sector. However, know that China is rapidly increasing its market share as the government attempts to deal with China's low-tech driven shipping industry to more profitable sectors such as LNG tankers and offshore vessels. China secured 10 orders in 2013 and further 3 this year. However, most of the Chinese orders for foreign operators are relatively small tankers at around 27,000 cubic meters, with China's Shipping Group Co. ordering the largest tankers at 174,000 cubic meter capacity from the Hudong Zhonghua yards. Chinese yards largely base their competitiveness on price, and while South Korea leads in technology. This is a situation that will not change in the short term, but if the Chinese SOEs, the state-owned enterprises, receive more funding for R&D, or if technology transfer is allowed, such as the case of Kawasaki deciding recently to base more LNG construction in China in order to compete with South Korea, then the picture might change drastically in the next 10 years. The existing fleet reflects the changes we're seeing taking place in tanker orders, with traditional operators such as Qatar Gas being static, largely due to domestic policies on gas export, while many smaller companies are set to become capable fleets themselves in the next 2 or 3 years. So these two charts show the top 10 operators by numbers of ships, and we can see the largest increases of ship orders are actually with the relatively small fleets that we have right now, which will take them almost on par with the highly established larger trading fleets of today in a very, very short time. We now move on to look at the current traffic patterns of the LNG fleet in service. This slide shows a snapshot taken on the 1st of July on the IHS Maritime AIS tracking software, AIS Live, showing the current LNG tanker fleet in operation around the world. Expected, the majority of the traffic is concentrated in East Asia, with particularly heavy traffic from Qatar and Australia. In terms of traffic density over a period of time, we ran some analysis on the AIS readings and plotted the density as a heat map for the last quarter of last year. This shows clearly the dense traffic from the Gulf to Asia, as well as the often used routes in the Mediterranean, Suez, and the Channel. Now we'll drill down in more detail in 2 of the densest traffic areas, that of EMEA and Asia. Firstly, EMEA shows quite complex traffic patterns with LNG shipments heading south to north from Qatar, as well as north to south from Norway. There are also shipments coming north from Nigeria. The blue circles show the terminals that have seen the densest traffic during this time period. Asia is more straightforward, with China, Japan, and South Korea receiving considerable numbers of vessels. Note the cluster character of terminals in southern Japan compared to the more regional hubs in China. We see Russian traffic from Sakhalin, as well as Australian traffic heading north through the Philippines. In terms of port callings, the majority of LNG ships head to Japan and South Korea as expected. Note the high number of callings in the Japanese Korean ports as compared to China. We will now briefly discuss the prospects of two new potential future LNG trade routes opening up in the future that will have a significant potential impact on the LNG trading outlook. The first has been often talked about in the media in recent months, and that's the North Sea route connecting Russian projects in Yamal to the Northeast Asian market. This is a proven route with shipments already having transited in the past few years. However, it's still not mature for a number of reasons. But if we can see the map now, the current route from, say, a European project, a Norwegian project, to Japan would take up to 34 days if it went through the Suez Canal. However, with the North Sea route, it would take only 23 days. That's even after factoring in very slow steaming through the somewhat hazardous waters in the Arctic. So some of the problems still exist for this particular route. Firstly, the passage requires icebreaker escort even during the summer months. And the majority of the icebreakers in the area are owned by Atomflot, the Russian Atomflot, are actually engaged in escorting other vessels during the summer months. So only two out of the max 3 icebreakers are available for this period to actually escort LNG tankers. And even though the Russian government is trying to build newer icebreakers, we're not going to see many of them coming online for quite a few years. And secondly, Russia also holds the right of passage, and they can change passage rates as well as charter costs for the icebreaker fleet as they see fit. And finally, search and rescue in such a hazardous region still remains quite an issue, with very, very few aircraft and helicopters available, for example, to search the waters. And also, any vessels used to rescue any stranded vessels caught in the ice would require icebreaker escort themselves. The next route we look at is the Panama Canal expansion, which, upon completion, will allow 89% of the existing LNG fleet to pass. This will shorten routes considerably and make potential future exports of US gas to Asia a very cost-efficient way. So as we can see now, if the US Sabine Pass projects was going to be exported to Dalian, going by without going through the Panama Canal would take up to 43 days. However, going through the Panama Canal would lower this journey time to only 28 days, so a significant saving in operating overheads. However, this route also depends a lot on prerequisites largely linked to US willingness to export large quantities of gas in the near future, obviously. Other routes, such as Eastern Australia, might just beat them to it and become a much better alternative of cheaper gas for the East Asian market.
Okay, so with that, let's wrap things up for today's webinar. Hope you found today's webcast to be useful, and also you're able to join us for future webcasts as we move forward through the rest of the year. Thanks very much for your time.